All right, guys, welcome back for another video. Well, today's video, I just want to do a very, very high level overview of basically my thoughts on the market, kind of get ahead of the quarterly and yearly close coming up at the end of the year. Now, of course, I'll do a video following up on that as well. But I do think it is important to kind of think big picture as we get towards the end of Q4, yearly close. Um, and so, anyway, I just want to run through some of the big picture ideas, starting with the DXY, the dollar currency index. One of the big things I've been looking at is basically we have this parabola that formed basically since May of 2021. Um, so you can see the dollar currency index actually bottomed in May of 2021. You could even make the argument in December of 2020. It's the absolute bottom actually came in right there. Now, the parabola didn't start until much later, but the point here is that the bottom in the market started in December of 2020, and the Fed didn't announce their intent to raise interest rates until a year later. So, literally a year later after the market bottomed. And then it didn't actually raise interest rates until, much later than that, like actually physically raise the rate of interest. So, this is just to illustrate the point that the markets are very forward looking. And so we have this, parabola as funds chase yield. In the FX market, there's something called interest rate parity. So interest rates chase yield. That's exactly what we saw here. But now what's interesting is that it's another case in point for how the markets are forward looking. So, a lot of people were looking for the Fed to announce some type of pivot or some type of reduction in interest rates for the dollar currency parabola to, put in its blow off top. But we actually saw it broke the parabola 2 months ago, 2 months from today. And we haven't really seen a pivot from the Fed. They have slowed the rate of interest rates hikes, but they've blatantly said, time and time again that they wouldn't think about cutting interest rates. So it's interesting that the parabola has blown off 2 months ago. Now, one interesting dynamic in markets is that, parabolas always blow off, but market psychology takes a lot longer to catch up with those parabola blow-offs. Um, but the point is that the market is forward looking, right? The parabola blew off before the Fed announced any changes in their policy. And that's because the market's basically looking forward roughly 6 to 9 months, 2 to 3 quarters. And what the market's telling you here is, the way I would interpret it is the market thinks that, probably sometime by Q3 of next year, interest rates will have peaked. They're starting to taper off right now, but, probably will peak around that Q3, Q4, start of Q4 next year. And that's actually kind of in line with some of the Morgan Stanley predictions. They have interest rates, rising at a tapering level into 180 days, and then peaking after that and slowly coming down. But anyway, this is a very classic parabola break. It's not. People have different. Whether you're looking here or here or here. The idea is basically that you can put a let's see can put a horizontal line right here. So you get this thrust up, price comes down, fills this top right here, bounces off. Now, if the parabola were to continue, right, and we can zoom in on this, but if the parabola were to continue, it would have bounced off this resistance turn support right there and continued the parabola higher. But it didn't do that, right? It started the process of breaking down right here, and you get a stop run here, right? You break the parabola, but remember, this is just an imaginary line right here. Then you come down and do a stop run below these lows right here, just run just below, then run up into a bearish retracement, something like this. And that's really your big sell, right? That first bearish retracement, that's when the volatility comes in, come down at this level. And, you probably see, some type of low forming, relatively, not necessarily right here, but at some point, the dollar would probably put in a base and rally off that. So, but I think on the big picture, when we're talking about the quarterly, we want to keep in mind that, you know, the parabola has blown off, right? So, you know, it's probably see some type of sideways action and lower. It would be my guess for next year, right? Not necessarily, the floor doesn't necessarily have to fall out. I mean, in a lot of ways, the floor kind of has fallen out if you longed up here. But I would, the way we saw those, this first daily bearish retracement, which was the ideal sell, I think you probably see something similar. Now we don't necessarily have a low formed here, but at some point, the the market will put an intermediate low, and that that'd be a good area to draw a retracement, right? Then you might, where we had the daily retracement here, then say the market maybe takes another swipe of the lows down here. Again, we're kind of getting ahead of ourselves right here, but the idea is that this type of fractal pattern that occurred on the daily will probably start to play out on the higher time frames as well, as we talk about the monthly and quarterly, also the yearly close as well. So you know now the yearly open is pretty significant. If you just go back to the you know you can kind of see how it generally does serve as a pivot. But broadly speaking, any quarterly pivot or any quarterly open and close is going to serve as a pivot as well. Now that we have that dollar currency blow off, what is the, how does that transpose onto the broader equity markets? Well, what's interesting is, the Dow Jones index has actually led the broader indexes. So here you just have, pretty classic weekly downtrend here. See NAS 100, similar, even more exaggerated here as well. But on the Dow Jones, you've got a different pattern, right? You've got higher highs right here, which is significant. Now, if we look on the 12-month chart, right, you can see it's kind of, right, it's hard to see all the bearishness that we've been feeling and experiencing if you're solely looking at the 12-month chart, right? It makes you wonder, like, how many different bought lows on this chart were people maximizing their bearishness, right? It's hard to say, but the interesting thing here is that that the we have new higher highs on the weekly. So if we go right here, mark this off, that's a classic liquidity run. Something actually I talked about earlier. Was kind of looking for that distinction on SPY, but it actually happened. On the Dow Jones. The Dow Jones actually led. So after this liquidity ran, and then you get the stop losses hit above here, and you get major sell off. I wouldn't necessarily expect the quarterly to close above, right? A lot of this is very characteristic, right? You probably you've got a break of trend. The quarterly may close somewhere below here, and then some other type of price action to convince people to reopen short positions, even despite the change in structure. Now, somebody might be asking, well, how do you know if the structure is about to be broken, or if things are about to be changed around? Well, the RSI did give some indication that was about to happen. If we pull out the RSI right here, you can see here that so you gotta look at the big picture in these things, right? You've got the 200 weekly moving average, and if you just look historically, right? I mean, despite the recession, which people may think we're in 08 style recession, but ever since 08, this area has been a typical bottoming area. Now it went pretty dramatically below it in 2020, but you can see price comes down to it here, comes down to it here, comes down to it here, comes down to it here. If you are an investor, statistically speaking, buying around the 200 weekly moving average on the Dow Jones, historically, has given you an edge, right? And then price comes down here, but not only does it come back down here, but you can see a similar structure occurring on the RSI, right? Kind of bottoming indication, right? So you come down on the 200 weekly, and you get multiple drives of RSI divergence, right? So one drive here, one drive here, and then you break above, right? It's just very, if you take a big picture view, right, and don't identify this time as like being different than other times, then you can see how, if you just were looking at this as if you were a computer and you had no idea what the news was and what everything else is going on in the world, you'd probably say, oh, okay, this is generally where the market, forms the low, right, or forms the bottom on the macro. And, you know, so it's kind of an indication, right, that you see the RSI there coming in at that historical interest level. It's giving you an indication that, okay, maybe this is an area where price will, turn around and reach for new highs, right? That's ultimately what it did. Now the carryover now is that on the Dow Jones, there's no longer a downtrend on the weekly, whereas you have a downtrend with SPY and Nasdaq. So I guess the question is, do we pay attention to this or do we focus on SPY and Nasdaq? Now that's something to pay attention to in the next quarter, Q1 of next year. I think it's very unlikely that SPY and Nasdaq set new weekly highs, um, you know, within the next 10 days. But something to pay attention to in Q1 is, do the Nasdaq and does SPY follow in the Dow Jones footsteps, or does it take the lead and create new lows? That's really important, right? You want to look for that follow through, right? If SPY and Nasdaq create new lows, then it's probably telling you that they're leading the market and Dow Jones is not as leading of an indicator, maybe as we would be led to believe right now. But if we go over to SPY, just as an example, you can kind of see that same formation on the RSI, the three drives of divergence that we saw in Dow Jones before it took out the weekly highs. Coming off that weekly 200 like we saw in the Dow Jones. So you've got the same pattern forming. So, it's not unreasonable to think that SPY could reach for the highs up there and break the weekly downtrend structure. Again, just the bullish perspective. And again, just looking at this, purely from a statistical model, I know there's a lot of stuff going on in the world that is, uh, very fearful and very fear-inducing. But that's the way it always is at the bottom, right? So I guess my argument for why I maintain a bullish bias in these situations is that I don't think that this time is different than the other bottoms, right? There's a certain level of fear that is always present at this phase in the market, at every low, right? And I don't really think that this time is uniquely different. I'm actually a bit of an optimist. I tend to believe that the future is very bright, and there's a lot of things going on that are actually positive that we can look forward to. Um, one thing in particular, I do think inflation has peaked relatively. Doesn't mean to say that inflation won't be, that the prices of goods won't be much higher like 20 years from now. Of course it will. But I think in the intermediate term, I think prices will have peaked and will be trending down relative to where they were a few months ago. One way to kind of look at that is we can go to the U.S. Treasury yield. Let's see. The U.S. Treasury yield. All right, so here's the 10-year note yield. Now, what's interesting now is if you look across a lot of different duration bonds, you can see that most of them are all significantly below the federal funds rate. So after the last FOMC meeting, The Fed raised their federal funds rate to roughly 4.25. Now, that's a cumulative rate, but it's not a definite measure, but it's roughly around 4.25. And now you have a lot of different, maturities on different U.S. Treasury maturities, all yielding significantly lower than that federal funds rate. And that's a really big deal because, if you buy bonds, you're taking substantial risk in the value of that bond. If interest rates rise, right, the value of the bond itself will decline dramatically. You don't take that risk when you park funds in the reverse repo market at the Fed. So I guess the significance here is that you've got the 10-year Treasury yield yielding almost 100 basis points below the federal funds rate. So you can see here, this is a chart of the 10-year yield. It's at 3.564. The federal funds rate, again, is yielding roughly around 4.25. So not exactly 100 basis points, but like 75 basis points. And if you even go down to the 2-year, the 2 years yielding a little bit more than that, but still less than the federal funds rate, about 10 basis points less than the federal funds rate. And so you've got all the different yields on treasuries yielding lower than the federal funds rate. And that's something that I had identified previously as, being a major red flag, right? Because it represents demand destruction in the bond market. And I think that's why you're seeing, the dollar currency blow off, right? The parabola blow off. Not only do you have an inverted yield curve in the bond market, but you also have all the different duration bonds now trading below the federal funds rate, which is it dramatically destroys the demand for treasury bonds because uh, it's way less risky for banks to park their capital with the Fed at the reverse repo market that's offering a higher yield with zero risk, right? Zero counterparty risk, zero notional value of the bond risk as well. So, and conveniently, you can see that the yields, uh, you know, topped out right around when the dollar currency index blew out 2 months ago. So I don't think that's a coincidence. I think the market was kind of, again, the market is forward looking. It kind of knew that yields would drop relative to the federal funds rate. And basically what the market is saying is that the market's telling you that, regardless of what the Fed may say, structurally, the bond market is in a place where demand for treasury bonds has, cratered to the point where even though the Fed is saying that they're not going to purchase bonds, that the period in time where they'll actually have to step into the market and start purchasing bonds is way faster than somebody might pick up just by simply listening to their speeches. Again, the market is forward looking, so it doesn't necessarily mean that is going to happen next month, but probably, again, within that 6 to 9 month time period, the market's telling you that, the Fed is going to need to buy bonds and fill in that gap, right? You can't have the federal funds rate, trading above the bond yield. It just doesn't work. So they'll either have to lower interest rates, and the way they do that is by both lowering the federal funds rate and by purchasing treasury bonds and driving those bonds yield even lower. But the most effective strategy is just to cut the federal funds rate to resolve that issue. Anyway, I hope you guys like this video. If you do like this content, just make sure to subscribe to the channel and stay tuned for more